Smart millionaires are liquidating their real estate portfolios at rates we haven't seen since 2008. And if you're still buying property thinking it's the safest investment, you're about to learn a very expensive lesson. Kevin O'Leary recently warned that we're entering the most dangerous period for real estate investors in 40 years. Here's what you need to know. Right now, institutional investors and high net worth individuals are quietly exiting real estate positions while retail investors are still piling in, convinced they're buying assets. The data tells a completely different story. In the last 18 months, private equity real estate funds have sold over $127 billion in commercial properties, the largest divestment wave since the financial crisis. Wealthy family offices have reduced their real estate allocations from an average of 32% down to 18% of their portfolios. But here's what most people don't realize. This isn't just about commercial real estate. Residential property investors with portfolios of 10 or more properties are selling at a pace 340% higher than the 5-year average. These aren't distressed sellers. These are sophisticated investors with decades of experience who understand something the average person doesn't. Kevin O'Leary, who's built multiple fortunes across different asset classes, has been vocal about this shift. He's not anti-real estate. He's anti-stupid investment decisions. And right now, the math on real estate has fundamentally changed in ways that make it a wealth destroyer for most people, not a wealth builder. The truth is, the conventional wisdom about real estate being the path to wealth is based on economic conditions that no longer exist. Let me break this down for you. Number one, the carrying cost crisis is destroying returns. Let's start with the most immediate problem that's gutting real estate profitability. The true cost of ownership has exploded beyond what rental income can support. Most amateur investors calculate their returns based on mortgage payments and maybe property taxes. That's financial suicide. Here's the reality. Interest rates have tripled from their 2021 lows. If you're financing a property today, you're paying 7 to 8% on a mortgage compared to the 2.5 to 3% rates that made real estate work just 3 years ago. That difference alone wipes out most of your cash flow. But it gets worse. Insurance costs have skyrocketed 35 to 50% in the last 2 years, depending on your market, with some coastal and disaster-prone areas seeing increases over 100%. Property taxes continue rising as municipalities scramble for revenue. Maintenance costs are up 28% due to inflation in materials and labor. When you actually calculate the all-in carrying cost, most rental properties are now cash flow negative or barely breaking even. Smart investors understand this. If your property isn't generating at least 8 to 10% cash-on-cash return after all expenses, you're losing money in real terms when you factor in inflation and opportunity costs. The wealthy are doing the math and realizing their capital is trapped in underperforming assets. They're selling to people who haven't done the calculation yet. Before we continue, understand this. The investors buying right now are either speculating on appreciation, which is gambling, not investing, or they simply haven't stress tested their numbers against reality. Number two, the liquidity trap that keeps you poor. Here's what they don't teach you in those real estate investing seminars. Illiquidity is a wealth killer, especially in volatile markets. When you tie up $100,000 in a property down payment, that capital is locked. You can't easily access it, you can't redeploy it to better opportunities, and you can't protect it when markets shift. Real world scenario, you own a rental property worth $500,000 with $200,000 in equity. The market starts declining, interest rates spike, and suddenly you need capital for an emergency or a better investment opportunity emerges. What are your options? You can't sell quickly without taking a massive discount, typically 10 to 15% below market value for a fast sale. You could do a cash out refinance, but at 8% interest rates, that's financial suicide. Home equity lines of credit have dried up or come with rates above 10%. Meanwhile, institutional investors hold diversified portfolios. They can rebalance in seconds. They can move capital from underperforming real estate into bonds yielding 5%, money market funds paying 5.3%, or equities positioned for growth. They have optionality. You have a property you can't sell without losing money and can't access the equity without expensive debt. The data shows this clearly. During market downturns, illiquid assets like real estate typically take 18 to 36 months to fully reflect the new pricing reality, while liquid markets adjust in weeks. That means you're watching your wealth evaporate in slow motion while being unable to do anything about it. Most people miss this connection, but wealth isn't just about returns. It's about having the flexibility to act when opportunities arise or when you need to protect your capital. Number three, The appreciation myth is bankrupting investors. Let's destroy the most dangerous belief in real estate investing, the idea that property values always go up over time. This myth has destroyed more wealth than almost any other financial misconception. Yes, real estate has appreciated historically at about 3 to 4% annually on average. But here's what the data actually shows. That's barely above inflation, and it's heavily concentrated in specific markets during specific time periods. The median U.S. home price has roughly matched inflation over the last 120 years when you exclude the coast and major metro areas. More critically, we're at the end of a 40-year period of declining interest rates that artificially inflated asset prices, including real estate. From 1981, when rates peaked at 18%, they fell consistently to near zero during COVID. Every percentage point drop in interest rates increased housing affordability and pushed prices higher. That era is over. Here's the math that smart investors understand. When interest rates rise, property values must fall to maintain equivalent affordability. If rates go from 3% to 7%, a buyer's monthly payment on the same price property increases by roughly 40%. For prices to stay affordable to the same buyer pool, prices need to drop. We're already seeing this in many markets where prices have declined 10 to 15% from 2022 peaks, but there's more downside coming. Successful investors don't bank on appreciation. They invest for cash flow and treat any appreciation as a bonus. Right now, you can't get adequate cash flow, so you're purely speculating on price increases that economic fundamentals don't support. But this next one is even more critical because it affects every real estate investor, regardless of market conditions. Number 4, the tax advantage has been neutralized for decades. Real estate's tax benefits were its superpower: mortgage interest deductions, depreciation write-offs, 1031 exchanges, and long-term capital gains treatment. These advantages made real estate competitive even when raw returns were mediocre. That equation has fundamentally changed. The 2017 Tax Cuts and Jobs Act capped state and local tax deductions at $10,000, which eliminated a major benefit for property owners in high-tax states. The standard deduction was raised to $13,850 for individuals and $27,700 for married couples, which means most people don't even itemize anymore, so mortgage interest deductions provide zero benefit. Meanwhile, alternative investments have become more tax efficient. Municipal bonds are paying 4 to 5% completely tax-free. Qualified dividends get preferential tax treatment. Index funds are extraordinarily tax efficient through low turnover. You can hold these in tax-advantaged accounts like 401ks and Roth IRAs, which you can't do with physical real estate. Even the depreciation benefit is overstated for most investors. Yes, you can depreciate the building portion of a property over 27 and a half years, but that depreciation gets recaptured when you sell, taxed at up to 25%. It's tax deferral, not elimination. And if you're not generating positive cash flow, depreciation losses that exceed your rental income can only offset other passive income, not your W-2 wages. They're trapped. Wealthy investors are realizing that after factoring in the true effective tax burden, real estate's after-tax returns are no better than a diversified portfolio of stocks and bonds, but with 10 times the hassle and zero liquidity. Here's what the data shows. When you model out a 10-year hold period with realistic assumptions about cash flow, appreciation, taxes, and transaction costs, most real estate investments underperform a simple 60-40 stock-buying portfolio on a risk-adjusted basis. Number 5, the management burden is a hidden tax on your time. Let's talk about the cost nobody calculates: your time. Real estate is sold as passive income, but anyone who's actually owned rental property knows it's anything but passive. You're dealing with tenant calls, maintenance emergencies, vacancies, property management, insurance claims, and endless administrative work. Even if you hire a property manager, which typically costs 8 to 12% of gross rents, you're still the ultimate decision maker and problem solver. That property manager calls you when there's a major repair decision, a tenant dispute, or an eviction situation. Your weekends get consumed with property issues. Your mental bandwidth is occupied with real estate problems instead of focusing on your actual career or business where you can generate higher returns. Here's the comparison wealthy people make. If you're a high-income professional earning $150,000 to $300,000 annually, every hour you spend on real estate management is an hour you're not spending advancing your career, building your business, or developing skills that compound your earning power. That opportunity cost is massive. Real-world example: a physician friend owns 3 rental properties that generate $2,500 per month in net cash flow combined. $30,000 annually. Sounds good until you realize he spends roughly 200 hours per year dealing with property issues, tenant management, and maintenance coordination. That's $150 per hour, less than half his actual earning rate. He'd be financially better off working one extra shift per month and investing the income in index funds. Institutional investors avoid this trap entirely. They own shares in REITs or real estate funds with professional management. They get diversification across hundreds of properties. They have complete liquidity, and they spend zero time on management. They're extracting real estate returns without the burden. Number 6 will surprise you, but first understand that the smartest investors value their time as much as their money, and real estate is a time vampire that destroys both. Number 6, the concentration risk is catastrophic. This is where amateur investors make their biggest mistake. They concentrate massive amounts of their net worth in a single asset class, often in a single geographic market. This violates the most fundamental principle of investing, diversification. Most real estate investors have 60 to 80% of their net worth tied up in 1 to 3 properties, all in the same city or region. You're exposed to local economic decline, regional natural disasters, city-specific tax increases, local rental market saturation, and area-specific regulatory changes. That's not investing, that's rolling the dice. The numbers don't lie. Markets that boomed during COVID, like Austin, Phoenix, and Boise, have seen 15 to 25% price corrections as remote work trends reversed and people move back to major metros. Investors who concentrated in those markets, convinced they'd found the next big thing, are now sitting on losses and negative cash flow. Compare this to how successful investors structure their wealth. They might have 20 to 30% in real estate, but it's through REITs that own thousands of properties across dozens of markets. They have 30 to 40% in diversified equities across sectors and countries. They hold 15 to 20% in fixed income for stability. They maintain 10 to 15% in cash or equivalents for opportunistic deployment. This diversification protects them. When real estate struggles, their bonds and dividend stocks provide income. When stocks correct, their real estate holdings and fixed income cushion the blow. They're not praying that the specific neighborhood where they bought a fourplex continues appreciating. Here's what research proves. Concentrated portfolios have dramatically higher volatility and risk-adjusted returns that underperform diversified portfolios by 2 to 4% annually over long periods. You're taking more risk and getting worse returns. The worst possible combination. Smart money understands that real estate should be one component of a portfolio, not the entire strategy. Right now, they're reducing that component because the risk-reward is broken. Number 7, the exit is going to be brutal. Here's the final piece that should terrify anyone holding real estate right now. When this unwinds, you're going to be selling into a market flooded with desperate sellers and very few buyers. That's how wealth gets permanently destroyed. We're already seeing the early signs. Days on market have increased 32% year over year in most metro areas. Price reductions are happening on 40 to 50% of listings in many markets. Buyer traffic is down despite prices falling because affordability remains destroyed by high interest rates. But most people don't realize the real avalanche is still coming. There are roughly $1.5 trillion in commercial real estate loans maturing between now and 2025 that can't be refinanced at current rates without owners injecting massive new equity, which they don't have. Those properties will be forced sales. Residential investors facing negative cash flow will capitulate as their reserves deplete. Boomers who own rental properties and are aging will look to liquidate, adding more supply. Meanwhile, the buyer pool is shrinking. First-time buyers are priced out completely. Investors are exiting, not entering. The only buyers left will be opportunistic institutions waiting to pick up assets at massive discounts. Real-world scenario, you bought a property in 2021 for $400,000 with 20% down. You need to sell in 2025 due to job, relocation, or financial stress. Comparable properties are now listed at $350,000, but they're sitting on the market for 90 plus days. You need to price at $330,000 to actually sell. After paying 6% commission, $19,008, and closing costs $5,000, you net $305,200. You still owe $315,000 on your mortgage. You have to bring $10,000 to the closing table just to get out, and you've lost your entire $80,000 down payment plus any principal you paid down. That's not a worst-case scenario. That's a realistic outcome for millions of property owners in the next 24 months. Successful investors are selling now while there's still some liquidity and demand, even if it means leaving some potential upside on the table. They understand that protecting capital is more important than maximizing every last dollar of return. So what's the smart money strategy? If you currently own real estate, you need to make an honest assessment. Run the numbers with brutal honesty. What's your true all-in, cash-on-cash return after every expense? Can you sustain negative cash flow if it continues for 2 to 3 more years? Do you have enough liquidity outside of real estate to weather a downturn? If the answers make you uncomfortable, it's time to consider selling while you still can. Instead of concentrated real estate holdings, successful investors are reallocating to diversified portfolios. Right now, you can get 5% to 5.3% in treasury bills and money market funds with zero risk, complete liquidity, and no management burden. Investment-grade corporate bonds are yielding 6 to 7%. Dividend aristocrat stocks are paying 3 to 4% with growth potential and complete liquidity. If you still want real estate exposure, do it the smart way through REITs that trade like stocks, giving you instant liquidity, professional management, diversification across hundreds of properties, and no management headaches. You can dollar cost average into positions, you can rebalance quickly, and you're not concentrated in one market. The framework is simple. Prioritize liquidity, diversification, and capital preservation over speculation on appreciation. Build a portfolio that can weather multiple economic scenarios: rising rates, recession, inflation, deflation. Real estate in its current form can't do that. A properly diversified portfolio can. This is how you protect your wealth when markets shift. You don't wait for the crash to act. You position yourself before it happens. The wealthy aren't smarter than you. They're just willing to act on data instead of hope. Let's recap what we've covered. Smart millionaires are exiting real estate because the math is fundamentally broken. Carrying costs have exploded, destroying cash flow and returns. Illiquidity traps your capital when you need flexibility most. The appreciation myth is collapsing as the 40-year interest rate decline reverses. Tax advantages have been neutralized while alternative investments have become more efficient. The management burden consumes time that high earners should spend elsewhere. Concentration risk violates basic investing principles and amplifies losses. And the exit is going to be brutal when everyone tries to sell at once. Kevin O'Leary has warned repeatedly that investors need to be ruthless about capital allocation right now. This isn't about being pessimistic, it's about being realistic. The economic conditions that made real estate a wealth-building machine for the last 15 years have reversed, and most people haven't adjusted their strategy. If this resonated with you, the action step is clear. Audit your portfolio with honest numbers, not hopeful projections. Compare what you're actually earning in real estate against what you could earn in liquid diversified alternatives, and make decisions based on math, not emotion or outdated conventional wisdom. You control your financial future by making informed decisions based on reality, not by following strategies that worked in a different economic era. Smart investors adapt. Wealthy people protect capital first and chase returns second. That's how you build wealth that lasts instead of watching it evaporate when markets shift.